back. You're watching Investors Guide and ET Now. Anil Shagal joins us on this leg of the show to answer all your investment questions. Anil, always a pleasure to have you on the show. Our first question comes in from Anil Shagal. He says he invested in the LIC Jeevan Shri policy and the ICICI Prudential Assure Wealth plan. He wants to know if he should continue with these policies or should he surrender them. Anil.
Shamik, your question is in two parts. The first relating to your policy. As far as your LIC Jeevan Shri policy is concerned, now this is a traditional plan where you are considering whether to make it paid up. The LIC Jeevan Shri plan allows you to make the policy paid up. However, the consideration for you would be that after you make it paid up, also your accrued benefits will continue. Your sum assured will be reduced proportionally to the amount of premiums that you pay, and no further benefits will be accrued. So that is the impact if you make the policy paid up. As far as your LIC Prudential Assure Wealth Super is concerned, this is an old style ULIP, and therefore under this policy you can surrender the policy after 3 years if you so desire. However, there will be a surrender penalty which is applicable. Under the new ULIPs, as you know, there is a lock-in of 5 years and there is no surrender penalty after those 5 years. So you would have to pay a surrender penalty. You will have to then decide whether that surrender penalty is too high or is something that is palatable to you if you want to exit the plan. The second part of your question was relating to tax. So if your motivation for continuing or discontinuing the policies is the provisions under the DTC, which may become applicable from next year, I would just like to clarify to you that the grandfathering clause, which essentially will define how existing policies will be treated on maturity for tax purposes, is not yet clear. And I think till that clarification comes out, taking a decision on continuing a policy or discontinuing a policy based on potential tax liability is wrong, and therefore you should wait.
Alright, so the important thing you should remember when you're thinking about surrendering a policy is to check the surrender value. Maybe if you wait a year or two, that surrender value will increase and you'll take home more money. So keep an eye on that when you decide whether or not you want to pull out your money. We have another question from Anil Shagal. He's 34 years old and he works for an MNC in Bangalore. He wants to know which are the 5 best online term plans in the market, and he wants you to help him choose. Anil, according to your rating, which are the 5 best plans?
Chetan, you asked for about term policies as well as policies with reversionary bonuses and money back. So as far as term policies are concerned, you should be considering online term policies. And in these, the best ones that I could recommend to you are the online ones. So you could look at the Aegon Religare iTerm, you could look at the Aviva iLife, the Bharti AXA E Protect, you could look at the HDFC Click to Protect, as well as the Kotak E-Preferred and the MetLife Met Protect. So these are top 6 policies that you could consider. Your comfort with the company and the price at your age and the sum assured that you're looking at that the company will charge. So all of these are good policies and you can consider them. As far as policies which give a reversionary bonus and provide money back on maturity, it really depends on the term that you're looking at and the kind of benefits that you're looking at, as well as the sum assured that you're looking at. So what I would suggest to you is that, if you are not clear in the requirements, take the advice of a financial planning advisor to identify your needs and then evaluate the policies based on the benefits that they offer. I would also urge you to consider unit-linked plans simply because traditional policies tend to have a higher cost structure these days compared to ULIPs, and also have higher discontinuation charges compared to ULIPs.
Our next question comes in from Satavirappa, who writes in saying he is looking for an LIC policy for his 4-year-old son. He wants the policy to mature when his son is 18. He tells us he can invest 10,000 rupees every year, and he wants to know which policy he should choose. He has specified LIC, Anil, but are there better options out there than LIC for him?
Satyavirappa, if you're looking for a plan for your child, what I would urge you to do is to consider the following additional benefits or built-in benefits into plans when you are comparing them. The first one is a waiver of premium plan, which allows your policy to continue in the sense that the premiums will continue to be paid and the savings element for your child's needs will continue to be accumulated, even though the sum assured may have been paid on the event of death. And that will allow you then have a lump sum available at whatever age you want a lump sum to be available for your child, whether for education or marriage or whatever else. The other option that some plans have that you might want to consider is the availability of periodic payments that continue to be paid during the particular age for which you have taken the policy to pay for educational expenses. And this is in addition to the sum assured. These are useful benefits to have, which make sure that your child's education is not hampered in any way in the event of your death. So, I think based on your need, based on the term that you're looking at and the sum assured that you're looking at, keep in mind these additional benefits when you compare the plans and decide which policy to go for. The four suggestions that I could give you on child plans are the LIC Jeevan Chaya, the Aviva Young Scholar, the SBI Life Smart Scholar, and the Max Shiksha Plus. So these are four policies that I would suggest to you that you compare.
We have time for one more question. Yogesh Kapadia has written in. He wants to buy a term cover for 50 lakh rupees. He found out that the lowest premium is offered by Aegon Religare and Aviva Life. But he's not sure if he should buy these covers because he's suspicious about the fact that the premium is so low. Now, his friends tell him that he should pick a term cover from LIC, but that premium is 25,000 rupees. He wants to know what he should do. Anil, this is a question that pops up a lot, the toss-up between private companies that are really bringing down rates and, of course, LIC that has a government backing. Which would you recommend?
Yogesh, as far as your comparison of policies is concerned, I think you've taken the right step. You've identified two good policies, the Aviva iLife and the Aegon Religare iTerm. As far as your doubts on why the premiums might be lower here and what impact it might have on claims payment, what you need to consider is that these are online plans, and online plans typically have lower distribution and marketing expenses as well as operational expenses. And therefore, those costs are very often passed on to customers, and the prices tend to be lower as a result. The second thing is that these policies, some of them are taking into account more recent mortality experiences as well for companies. So in a nutshell, there may be good reasons why these policies are cheaper compared to some of the older policies. I don't think that the premium that you pay has any relationship to claims experience because I think policies tend to have similar terms and conditions and insurance companies typically will not deny a claim unless there is some ambiguity on the genuineness of the claim or an instance of misrepresentation and so on and so forth. So when you're taking a policy, make sure that there is no misrepresentation, that you've answered all the questions truthfully and given all the details. And typically your claims experience in that case should be all right. There are a number of protective covenants which are there to protect the interest of policyholders, including a right of appeal via the IRDA or the insurance ombudsman. So I think there are enough protective mechanisms there. Having said which, I think you're on the right track. You should look at what the claims experience and service experience across various companies is, just to satisfy yourself. What I would say is that a number of private insurers that you're looking at also tend to have fairly comparable claims payment ratios. And a number of insurance companies today have claims payout ratios in excess of 85 to 95%, depending on which company it is, which is quite similar to LIC in some cases. Compare it, look out for the data, and take a decision after looking at everything.
All right, unfortunately, we've run out of time on this show. Anil, it's always a pleasure to have you on the show. Thank you so much for answering our questions. If you have questions about anything that has to do with your money, write to us on the email ID that's at the bottom of your screen. Keep watching Investors Guide. Remember, next week we're making dreams come true. Thanks for watching. Welcome to Investors Guide. We have a fact show lined up for you today. It's really the end of the year, which means we are inching closer and closer to the tax quarter when we all do our tax planning. So we really have a fact show lined up. We're going to continue answering your questions, planning your portfolios. And speaking of answering questions, remember, you can write in to us at the email ID that's flashing on your screen. Remember to send in